This month, Life Insurance Strategies Group is in Scottsdale, Arizona. And we have a third division of Life Insurance Strategies Group. You're very familiar with our consulting division, where we work with high net worth individuals and institutions, helping them sort out complex life insurance transactions and running those transactions on their behalf. We also, of course, have the LISG Creative, which is a full-blown marketing agency. And there, our team acts as the outsourced chief marketing officer for any variety of producer groups, and carriers. But the LISG International division is the focus of today's video. Now, we think a lot about policy security nowadays. And when I say security, I think a lot of people, you have to break it into two parts. There's the financial security around the carrier itself, and then the financial security of the assets that are in the life insurance policy. So for example, when we're dealing with variable products like private placement life insurance, variable universal life, variable annuities, domestically in the US, we look at separate account legislation. So this separate account legislation means that the assets, these policy assets, are separate from the general account of the life insurance company and not subject to their creditors. So that's very important. Obviously people focus on the financial rating of the carrier, and whether or not that's super strong or not may not have as much impact if the assets are separated. Now, offshore, we have similar legislation depending on the jurisdiction. So for instance, in Bermuda, we have segregated accounts going back to the Act in 2000. In Guernsey, they have protected cells. That protected cells legislation goes back to 1998. They were probably the first in the market. We have segregated asset plans in places like Barbados, Puerto Rico, so we have segregated assets. But just because assets are segregated and not sitting on the credit or sitting on the balance sheet of the general account of the insurance company and subject to their creditors, doesn't necessarily mean they're safe. So we might have assets that are segregated, but what keeps an insurance company from just switching out those assets for something like a third-party promissory note? And that's happened. That happened in Bermuda probably about 8 years ago. So yes, things can be segregated or separate, but what security does that really have if a carrier can just switch things out? Now, the jurisdiction of Guernsey, I want to focus on there because they've got something pretty unique for their general account companies. They require that 90% of policy assets be kept in a trust with an independent trustee so that those assets cannot be used to satisfy the creditors in the case of a solvency. So you'll see some insurance companies putting 100% of those policy assets in those trusts. So there they have in Guernsey both a protected cell structure, for the separation of the assets, but then also a way to keep general account assets that are connected to the policies from being paid out to creditors to solve any insolvency claims. So that's pretty important. So again, what I'm trying to drive home today is that yes, there's security at the insurance company level, and there's also security at the policy level, and it's absolutely critical that a policyholder understand both. Now remember, at Life Insurance Strategies Group, we don't sell products. We help our individual and institutional clients make decisions about complex life insurance transactions. And if we can help you, reach out to us at lifeinsurancestrategiesgroup.com.